Welcome to the Analyst Edge, helping you shine in IB internship and analyst interviews and get ready to excel on the job. Today, we're covering one of the most essential topics in investment banking and corporate finance: valuation methods, how we estimate what a company is truly worth. Let's start with the discounted cash flow, or DCF method, often considered the most intrinsic way to value a company. In a DCF, we estimate the company's future free cash flows and then discount them back to their present value, using the company's weighted average cost of capital. The logic is simple. A dollar today is worth more than a dollar tomorrow. By discounting all future cash flows, we calculate what the company is worth today. The DCF relies on assumptions about growth, margins, and discount rates, which makes it powerful but also sensitive. That's why it's often used alongside other valuation methods for context. Next, we have the comparable companies analysis, or comps. Instead of projecting cash flows, we look at how similar companies are valued by the market. We select a group of peer companies, typically in the same industry with a similar size and growth profile, and examine their valuation multiples, such as EV to EBITDA. Then we apply those multiples to our company's metrics to estimate its value. It's a market-based approach, fast and useful for understanding how investors currently price similar businesses. The Precedent Transactions analysis is similar to comps, but instead of looking at public companies, we examine past deals involving similar firms. We identify comparable transactions, look at the valuation multiples paid, and use those to estimate the potential value of our company. It's particularly useful in M&A, where understanding what buyers have historically paid gives context for current negotiations. Finally, there's the LBO, or leveraged buyout valuation. Here, the question isn't what is the company worth, but rather, what can a financial buyer, like a private equity firm, pay while still achieving a target return? The buyer finances most of the purchase with debt, and the value depends on the company's ability to generate cash flow and repay that debt over time. It's often used to determine a floor valuation, the minimum price a financial buyer would consider. Here are 2 quick tips to stand out in interviews and on the job. 1. Understand DCF, comps, precedent transactions, and LBO, and know when to use each. 2. Be able to explain each method clearly and confidently. Interviewers value clarity and structure. If you found this helpful, subscribe for more actionable tips that help you think, speak, and perform like a real analyst.